Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include chatter from conferences recently, my interview with OptifiNow's Linn Cook on the proliferation of non-conventional products in the wholesale channel and the ways the sales process is adapting to meet savvy brokers. We have accusations of fraud against Federal Reserve Governor Cook. We have changes in borrower behavior due to tariffs, and we have the minutes of the latest Fed meeting that were released, which drove some investor sentiment, in addition to a 20-year Treasury auction yesterday. Thanks to today's podcast sponsor, First Close. First Close provides fintech solutions to HELOC and mortgage lenders nationwide, increases profitability, and reduces costs for mortgage lenders through systems and relationships that enable lenders to assist borrowers more effectively and ultimately shorten closing times. To learn more, visit firstclose.com. I was recently asked about some of the informal topics that I heard in the halls of the Western Secondary last week. Certainly the increase in non-agency lending, this time to shine for non-QM investors. For example, there was trying to hedge a pipeline in an era of tweet headlines, which is a concern, as is finding new executions. The trigger lead bill doesn't take effect until 6 months after it's signed, and it hasn't been signed, but there is some question about whether it will impact servicing values. Hedging builder business is always a treat. Other subjects included how bid tape pricing can be used in setting rate sheets, how granular pricing should be, how the FICO Vantage tumult might impact the secondary markets, and how mortgage pricing is always sticky when rates are going down versus going up. Oh, and let's not forget FHA versus VA pricing shifts. FHA loan sizes tend to be smaller. The VA program doesn't have the False Claims Act history, but these loans prepay faster on average, all of which can impact values. Changing subject slightly, Federal Housing Finance Agency Director Bill Pulte has accused Federal Reserve Governor Lisa Cook of mortgage fraud, referring her to the Attorney General for potential criminal prosecution. In a letter posted on social media, Pulte claims Cook falsely represented both a Michigan home and an Atlanta condo as her primary residence to obtain more favorable mortgage terms, an act that could violate federal statutes. While there's no indication she defaulted on either loan, the allegation centers on inconsistencies in property use declarations, including the latter listing of the Atlanta condo as a rental. This development comes as President Trump seeks to reshape the Federal Reserve with governors more aligned with his economic agenda, particularly those favoring interest rate cuts. Trump publicly demanded Cook's resignation, and sources told the Wall Street Journal that he's weighing firing her for cause. Cook, appointed by Biden in 2022 and the first black woman to serve on the Fed board, has typically supported dovish monetary policy. Ironically, that's a stance consistent with Trump's current preferences. The accusation against Cook is part of a broader pattern. Pulte, who now chairs both Fannie Mae and Freddie Mac in addition to leading FHFA, has used his powerful role in the housing finance system to target perceived political adversaries, including Senator Adam Schiff and New York Attorney General Letitia James. And we're seeing a growing body of evidence dismantling the early 2025 narrative that tariffs would have little impact on consumer behavior, with revised GDP data and detailed spending figures now clearly pointing to a more significant economic drag than initially assumed. While markets have fixated on the trade-related hit to Q1 GDP, a more subtle but crucial story is unfolding in consumer spending, particularly in discretionary categories. Revisions to inflation-adjusted spending reveal that initial estimates vastly overstated consumer strength. Q1 consumption was revised down from 1.8% to just 0.5%, and services spending from 2.4% to 0.6%, highlighting the weakness that coincided with eroding consumer confidence. Now, as tariffs bite, households are pulling back on discretionary services like dining out, recreation, and especially transportation, with air travel down 4.7% year over year, and auto maintenance and rideshares also seeing notable declines. And yes, we've truly reached the dog days of summer. Without much in the way of economic and news developments yesterday, though a few central banks released their policy statements, bonds ended yesterday near their starting levels in early trade. The U.S. Treasury sold $16 billion in 20-year bonds to okay demand, though foreign interest was on the light side once again. And the market slowly backtracked through the release of the FOMC minutes from the July meeting, which showed a discussion about persistent inflation. On the auction front, buyers' strike concerns have faded, evidenced by the muted reaction to the trio of tails at 3-year, 10-year, and 30-year auctions earlier this month. There was the potential that another tailed 20-year refunding would trigger a sharp sell-off. Recall that it was the 1.1 basis point tail at May's 20-year new issue that contributed to a spike and added fuel to fears of a buyer strike in U.S. Treasuries. For today's interview, I want to welcome to the show OptifiNow's Linn Cook to talk about the proliferation of non-conventional products in the wholesale channel and the ways the sales process is adapting to meet savvy brokers. He's VP of Sales at OptifiNow and has more than 20 years of experience in mortgage and finance technology, having managed loan origination systems, automated underwriting systems, and pricing technology. I know there's a big focus on non-QM, but if you could talk about the growth in wholesale just in general, I think that would be really helpful. Obviously, people know that huge players in the space, UWM, Rocket, they utilize the wholesale channel. It seems like historically, margins are tough in wholesale, but it's changed a lot to where companies are really focusing on it, and they're making certainly big waves in the overall origination space as a result. But can you kind of talk about trends that we've seen and where the wholesale channel sits today?
The trend is pretty telling, right? I mean, there is definitely a growth in the mortgage broker space, right? So there's more origination volume that's coming out of the mortgage broker space, which, zero-sum game. I mean, it's less from these retail banks or credit unions or whatnot, right? So there's definitely this shift towards becoming a mortgage broker, and more mortgage brokers are then therefore going to their wholesale partners. And looking at UWM, I mean, obviously you can see that they have just a tremendous share of the business of mortgage brokers. So naturally, they've been sort of riding higher. But I mean, I think it's more indicative, to me, it's more indicative of the trend of, more mortgage brokers as opposed to retail loan officers and banks. Like, why is that happening? It seems to me, and you've seen the market yourself too, Robbie. I mean, there's definitely been this sort of disruption over the past couple of years. COVID notwithstanding, right? I mean, just in general, the business model seems to somehow work better for loan officers as a broker, as opposed to being part of a larger lender, right? Like, I think that's the underlying current to me as to why wholesale has been trending upwards. And then again, sort of the expansion into the non-conforming loan products really is just more focused on brokers as opposed to lenders wanting to offer those products through their own retail loan officers.
Well, I'm hoping you can elaborate on that slightly, why we've seen this kind of opening in the non-conforming space, because it's certainly proliferated here recently, and you would think that hindsight being 2020, maybe some of these companies would have gone about it a little differently to try and get more of a foothold there. But what have we seen in terms of the non-QM space growing and how you see it continuing to evolve?
Well, I mean, again, there's been, several news articles lately touting sort of the growth of the non-conforming space. And this has been something that's been happening, well, I mean, nigh on 10 years, right? We've been seeing sort of these, obviously the jumbos and whatnot, those are really more kind of the prime, sort of non-conforming, non-QM. But when you look at the growth of the alternative sort of documentation products, right? Obviously the bank statements and the P&L, and then also sort of the growth, well, until this year really, but the growth in like foreign national types of loan products. Why that is, I'm not really sure, right? I mean, I guess from the standpoint of, hey, it's low volume, right? Relative to conforming product. Like, could a retail lender really survive or thrive enough off of just offering products to self-employed borrowers or to investors? Yes or no, right? I guess now they can, because there's considerable momentum, and the market has proven itself to be really resilient from the investor side of things. But could you start a retail lender that all you do is bank statement loans? I don't know if there's enough volume there to support that. But therefore, if you go in more of a wholesale model where you can go and just kind of farm and gather a whole bunch of originators across the country to generate enough volume for you to make, a sizable enough of a revenue and profit to satisfy not only yourself but also your investors. Obviously, I think that's what was kind of underlying the growth of non-QM within wholesale specifically. And again, you'd have to talk to one of my clients. I mean, they'll tell you whether that's true or not. But it just seems like you couldn't generate enough volume on your own. So doing it in a wholesale model, albeit with its inherent risk, but in a wholesale model would be a much more efficient way of generating enough volume.
I also wanted to talk a couple other products that were out there, these business purpose loans, whether that's DSCR. I think you had mentioned to me at the Western Secondary, that's comprising around 40% of total originations now in the space. So there's RTL as well. Can you touch on some of these that you're seeing really expand and there's certainly borrower demand out there?
Yeah, I don't think there's any secret to these non-QM lenders, right? I don't know if these business purpose or these types of loans are fully, 40% of the overall volume, but anecdotally, right? I mean, talking to my clients, yeah, I mean, they're telling me that of their non-QM volume, the DSCRs, RTLs are coming up, but the DSCRs, yeah, I mean, they're comprising upwards of 40, maybe even 50% of their overall volume, which is kind of surprising, right? I mean, these DSCR products are really, investor only products, and you would think, oh, there's a very small sliver of people in America that are real estate investors, right? I mean, you would think that, but it seems like that there's definitely a market and a hunger to make these types of loans. They seem to be relatively simple to underwrite. They seem to have pretty solid guidelines such that they're not imploding on themselves, obviously. And it seems to me that maybe sort of the credit box around DSCR is expanding a little bit, which is interesting, right? I mean, now they're kind of creating more potential borrowers around these types of business purpose loans than they may have been willing to accept before, which, if that's true, there's definitely have its own inherent sort of set of risks around that. It's not like we haven't seen that move before. But I mean, there's definitely a growing space for these investor types of products in the non-QM area. And then again, most of them are sold via this wholesale channel. To the extent where I have seen, I mean, and you've seen it too. I mean, there are definitely these wholesale lenders who only sell these investor type products, right? Like they're not even bothering getting into more of the ATR type of bank statement, products in that realm. So it's very interesting to see how that growth in DSR has really, in some ways, really powered the growth of wholesale.
Yes, and I'd be remiss if I didn't kind of tie what you're doing or what OptifiNow is doing into this, because it's helping change the sales process. And rather than tout your specific product, I'm wondering how we're seeing as a whole kind of sales processes evolve to aid people, both originators and consumers, and the time spent, their efficiency, various. What is the future of the sales process look like?
I'm not going to, make any broad sweeping statements, right? Like wholesale has been around for a long time, right? The basis for wholesale, it is a business, it is a B2B relationship, right? I mean, it is about one company talking to another company, touting their products and touting their benefits and their prices. And the way they do that is generally you have salespeople that work in this B2B environment, which generally involves having that type of relationship, type of sales model where you meet and greet and you get to know people and whatnot, drive the offices, drop off donuts, whatever it is. But I mean, there's no, and that will always be part of wholesale. I'm not going to discount, but I mean, come on, guys, it's like 2025, right? I mean, everyone is on Teams or Zoom, or everyone is pretty much glued to their computer all day long and their phone. So the wholesale model has definitely shifted more towards a kind of higher volume type of a sales process, right? And I don't want to call it a call center per se, but definitely it is predicated off of really the number of interactions you can have with different originators per day. It is for a lot of my clients, that is their primary metric, right? I mean, obviously volume plays into that, but I mean, they've seen a direct correlation between call volume and the amount of funded volume. So with that, they're using our system for sure to manage both types of inside/outside types of sales processes. But if you can get someone sitting in front of the phone and get them making, 30 to 40 phone calls per day, and your metrics are showing that at that rate, you can expect a certain level of loan submissions. And then off the loan submissions, then you can sort of, I guess, evaluate the quality of your caller based on sort of pull through of those submissions. But getting those submissions, in through the door is the name of the game from a sales perspective. So a lot of my guys actually are using more of a model where people are just on their phones, on their computers. They're not really leaving the office. They're making their calls. You can easily hook in the phone system to any CRM, including ours, so that you can make the calling much more efficient. But more importantly, getting the data to make those calls. And so we have done integrations. We've got partnerships with a lot of these different data providers. They're really the game changer to me, to be honest, because now we can just type in, straight phone numbers and email addresses of people who have known volume, who have known volume profiles that any AE or lender can actually look beforehand and just fill their pipeline with is just high quality leads with most current phone numbers and email. Like, that's super important, because just making those 30 to 40 calls, if you're only getting like a connect rate of like 5%, that's not going to do you much. But if you get 30, 40 calls and your connect rate is at like 30%, like, that makes a huge difference. So your AEs don't have to work 5 times as hard as they did before. So pulling that all together into one sort of environment, which is being our system or any kind of CRM, but really we specialize in wholesale. Having just a single machine that has all the data, has the calling capabilities, has the tools for the AEs to be super efficient. I mean, my God, you can literally take, a wholesale company from zero to like, 50 million a few months, right? Yeah, and I know that because I've seen my clients do it. They literally went from zero to like $50 million in a matter of like 5 months using sort of this model. So I think that's very telling in terms of why a lot of companies are actually turning to wholesale, because in some effects, yes, from a sales perspective, it's easier to prop up. Obviously, from the ops and the compliance perspective, yes, I mean that's very difficult either way. But knowing that you can actually generate that volume very quickly, I think that's gonna just lead to a lot more. Not a lot, but there's definitely going to be more wholesale lenders coming online with the over the next few years than we've seen before.
Yeah, well, I kind of want to close with the existential question of the moment, and that is, with all these technological efficiencies out there, how do you see the relationship between originator and borrower evolving? Or what is the originator now freed up to do that can help that relationship? And what are the most successful originators going to be doing here as we move into the future?
I think what it means is that these brokers now just have way more arrows in their quiver. Number one, they're much more educated. I mean, they know a lot more about a lot more different products than they did before. I mean, before, mostly brokers, all they knew was agency and like government products, right? But now they've got all these alternative financing types of products, means that they can go out and they can pursue way more different types of borrowers. And these wholesale lenders, they're getting so much better at doing the education and providing the brokers with the tools that they need. Whether it's just straight up education, or if they need collateral or anything, right? I mean, these wholesale lenders are really good at that. I mean, you look at UWM, I mean, they're even going beyond that. They're giving them, actual, LOS systems and actual CRM systems, and they're doing it. They're even doing the marketing for them, right? So, these wholesale lenders are definitely helping these originators be much better at their job, be much more efficient at their job, and give them more products to offer to more different types of borrowers. In my mind, that just means, look, we're going to see a lot more people, opt for this broker model who are current loan officers. And we're going to see a lot more people who are not even in the industry seeing, being a broker much more, approachable to them, accessible to them. And then I think the one thing that I'm definitely seeing, and a lot of people in the industry know this, because this broker model is working, because all these things are happening and making it easier for them to be successful as brokers, now we're going to start seeing an aggregation of brokers, right? And we have already seen it. I've already seen a couple of articles talking about the mega brokers, right? That are, to a certain extent, I mean, it may end up really dominating the industry. I'm hoping yes and no, because I mean, I think it's great if people have more choices and have that option to be much more independent. But yeah, I mean, you've seen it too, Robbie. I mean, there are these mega brokers that have like 500, 1,000, 5,000, who knows, brokers working underneath, a single sort of brand. So I think that is really kind of what's going to sort of trend everything towards this broker and this wholesale model. And the dynamics are going to change, right? Now that you have these mega brokers, now there's going to be, more of an incentive for these, larger wholesale lenders to want to cut deals specific to these mega brokers, right? And therefore sort of corner that market as well. That's another story.
It is another story. I'm torn between do you go quality a broker versus quantity when you're doing wrong? It seems like there's no winning thing. It's just exciting one way or another to see
It
where
is.
the industry is evolving. And I want to thank you for making the time. It was a pleasure meeting you at Western Secondary, and hopefully we'll do this again soon.
Yeah, thanks so much, Robbie. I really appreciate it.
The minutes from the July 29th and 30th FOMC meeting, when there were no changes to rates, indicated that only Governors Bowman and Waller preferred a rate cut. Interestingly, most Federal Reserve officials highlighted inflation risks as outweighing concerns over the labor market at their meeting last month, though President Trump's tariffs fueled a growing divide within the central bank's rate-setting committee. There was a focus on the apparent slowing in the labor market, with dueling risks on both sides of the Fed's mandate, and tariff-related inflation still a big topic of discussion. But the majority of the 18 policymakers in attendance judged the upside risk to inflation as the greater of these two risks. Their statement at the time characterized the labor market as solid, but said inflation remained somewhat elevated. Today's economic calendar kicked off with weekly jobless claims in at 235,000, higher than 225,000 expectations, and Philadelphia Fed manufacturing. Later today brings S&P Global Flash PMIs, existing home sales, leading indicators for July, Treasury announcing month-end supply, before auctioning $8 billion of reopened 30-year tips and conducting a buyback for liquidity's sake in 20-year to 30-year bonds for up to $2 billion, Freddie Mac's primary mortgage market survey, and remarks from Atlanta's Bostic. Today is also Class D 48 hours. We begin the day with agency MBS prices roughly unchanged from yesterday, the 2-year yielding 3.76, and the 10-year yielding 4.31 after closing yesterday at 4.30%. Let's wrap up with a joke and some housekeeping. Are you addressing your emails to whom it may concern? That's boring, cliche, and devoid of real meaning. You should address them to whom it's about to concern. That's exciting, innovative, and a call to action. Thanks again to First Close for sponsoring this week's podcast. Provides fintech solutions to HELOC and mortgage lenders nationwide, increases profitability, and reduces costs for mortgage lenders through systems and relationships that enable lenders to assist borrowers more effectively and ultimately shorten closing times. To learn more, visit firstclose.com.